Welcome. Welcome to Banking and Finance Laws course. This is the fourth week. This week we are discussing the powers and functions of the Reserve Bank of India and the other banks. This is the 18th session. In the previous session, we have discussed about credit control, and in this session also we will discuss some more measures of the credit control. That is, as part of selective credit control, there are qualitative measures and quantitative measures being taken by Reserve Bank of India and other banks. We have looked at few qualitative measures in the previous class, and we will continue with other measures, qualitative as well as quantitative measures, that the RBI and other banks will take to ensure credit control in the country. And as part of the powers and functions of the Reserve Bank of India and other banks, we have discussed in this week the establishment of Reserve Bank of India, its note issuing power, its credit control in the previous class. And we are continuing the discussion on credit control in this class also. So there are measures relating to willful defaulters. RBI started realizing there are few people who are intentionally doing some fraud to the banks or to the financial institution, and they are intentionally not repaying the loan, and they are trying ways to default the loans or other payment obligations. So RBI started being more cautious, and they observed such trend happening with some big business people or with some people with fraudulent intention, and RBI decided to regulate it, and so that it does not affect the financial stability of the country. So it started issuing some kind of guidelines to govern the willful defaulters. So there are some specific guidelines also and general guidelines also. Like for banks, they have given some specific guidelines. Similarly, for NBFCs, what kind? So for a particular category of financial institution, RBI can give guidelines. For a particular category within that, for one particular bank also it can give. That means RBI is empowered to give directions to all banks in general, or to all financial institutions including banks in general, or to all banks in general, and to one particular bank also, like that. So this is the power that RBI has under the RBI Act, and these directions can be addressed to all the banks and all the financial institutions, and like that. Now, what does these regulations or these guidelines try to govern willful defaulters like? So they try to say that there is a tendency that whenever there is a siphoning of funds to offshore accounts, the banks have to carefully look at the customer, look at the transactions, look at and see, yeah, are these people going to be future willful defaulters? Are there any people who are intentionally evading tax payments? Are there any fraudulent transactions happening? So the RBI provides a framework for these, identifying these willful defaulters, reporting about willful defaulters, and also RBI provides a framework where it gives measures so that the willful defaulters do not default, and prior only before they default, you identify with their fraudulent transactions and try to address that through their suppressing them. So in a way, it is like prevention is better than cure. In a way, you try to identify them with their activities prior before they default, and you report it and try to ensure that they don't take away the funds before they become they default the payment. So this is one of the qualitative measure to ensure that these people don't default the payments that they have taken from the banks or financial institutions. The other major measure about the qualitative measure is the priority sector lending. Now, priority sector lending can be said to be the major component of selective credit control. In a way, this is the one particular measure which has far-reaching consequences to the entire economy and to the public at large, and it imposes major restrictions on the banks also. Now, in 1967, National Credit Council was set up to study the credit needs of the economy and to identify the sectors which require prioritization and ensure that the credit access to those sectors are reached. So this was just before the social control on banks or just before the nationalization of banks. So because the credit needs of the country and the credit access to those sectors is a very, very important criteria for economic growth of any nation. And a nation's cannot grow, economy cannot grow unless their credit need and credit access is matched. So this requires that level of what we call suitable identification of the sector, and also allowing the credit to flow to those sectors requires very careful planning, careful understanding, and carefully designed scheme through which that particular sectors get the credit access. This is essentially the crux of priority sector lending. And Reserve Bank of India declares from time to time what are priority sectors. So it is not what you call static, it is dynamic. There might be priority sector in 10 years back, may not be the priority sector now. Say for example, in 1950, IT may not be a priority sector or something like that. So any priority sector is a sector which where the RBI thinks that there is a need that the credit should go to that particular sector. Now, Section 21 of the Banking Regulation Act empowers Reserve Bank of India to issue directions to the banks, and Reserve Bank of India can determine the policy in relation to advances to be followed by banking companies generally or by any banking company in particular, and the purposes for which they are to be made, the rate of interest, etc. And banks are bound to follow them. So here RBI is empowered by the provisions of the Banking Regulation Act, not just the RBI Act, but Banking Regulation Act also empower the Reserve Bank of India to regulate the banks. And what is this regulation? They can determine the policy in relation to advances. So what is the policy of lending that banks should follow? That RBI can determine, and it can give this to the generally to all banking companies, that is to all commercial banks or private commercial banks, or by any banking company in particular, say this particular bank should give, so it can give to one particular bank, or the purposes for which they have to be made, that is maybe agriculture or small industries, something like that. The purpose to which the loan has to be given also can be determined by RBI. The rate of interest that should be charged on these loans also can be determined by the RBI, and this power is entrusted to the RBI by virtue of Section 21 of the Banking Regulation Act in addition to the RBI Act. Now, banks are bound to follow them. There is no, because it is the RBI direction and they are bound to follow that. Now, say for example, one particular priority sector guideline reads like this, like all commercial banks with more than 20 branches are required to lend 40% of their net bank credit to the priority sectors. Now, what is this net bank credit? That means if bank has a total deposits of 100 crore, after its statutory liquidity ratio and cash reserve ratio and other obligations, suppose it is giving loans up to 80 crore. Now, out of 80 crore, at least 40% of it, that means 32 crore should go to priority sectors. So out of 80 crore, 32 crore should go only to priority sectors. So priority sectors include agriculture, housing, education, micro enterprise, etc. So RBI from time to time through its directive will declare what is the priority sector, what percentage of loan should go to that. And here there is again a twist. Within the priority sectors, they can provide further ceiling to specific sectors. Like say, total 40% you are giving to priority sectors. Within that, at least 18% should go to agriculture, like that they can determine. That means, again, there is a ceiling. So this is how that means you cannot give 32 crore to whomever you like. Within that, certain portion should mandatorily be given to agriculture loan as agriculture loan. Like that, they can, within priority sector, you can specify what priority sector receives how much also. There is also a preference to weaker sections to avail these loans, such as people coming, small and marginal farmers, persons with disability, people belonging to scheduled caste and scheduled tribes, or minorities, etc., they may be given further preference in the loan receiving process. And RBI mandates bank lending to priority sector through the master directives and circular, which it issues from time to time. And this is a major component of selective credit control measure of the RBI, because entire country's bank loans, for major portion of those loans are going to the sectors which RBI determines prior, and also some portion of that has to go to the people from weaker sections, and they get loans from time to time. So this ensures that people who should receive the loan, which sector should receive the loan, how much which sector should receive the loan. So this is aligned with the national development in general and to the national economic growth. So these were the qualitative measures that we have seen, and there are also quantitative measures that the Reserve Bank of India engaged to ensure credit control. Now, what are qualitative measures? Qualitative measures are the measures which ensure that the credit is received by people who should receive it, credit is received by sectors who should receive it, and the credit is not lost to cheaters and fraudulent people. Credit is not gone to the people who are not credit worthy, that the credit is not given to people who do not repay. And quantitative measure is a measure where the volume of credit availability, how much money should be available in the market, how much money should be available to the public at large, how much money should be there for giving loans. So this kind of volume, the measures taken to give the volume of money in the market is also called quantitative measures. So sometimes even the volume is determined by, there is a combination. Say for example, when we say the 40% of the credit should go to to the priority sectors as credit control measure, obviously that volume is coming into this sector. So some amount of overlap between these measures will be there, but however, quantitative measures are measures which are directly focused on maintaining only the volume of money, where it should go and how it has to be regulated, and how much money should be available in the market so that it is available for lending and so on. Now there are few measures like cash reserve ratio known as CRR, open market operations, bank rate and repo rate, and statutory liquidity ratio. This will determine the volume of money that is available in the market for the purpose of lending by the banks. Now, when we try to understand what is a cash reserve ratio and what is a statutory liquidity ratio, cash reserve ratio or the CRR is the percentage of money that banks have to maintain with the RBI. That means the RBI might say that 3% of bank deposits have to be deposited with the Reserve Bank. Then in this case, if the bank has 100 crore deposits, 3 crores goes with the RBI, and that 3 crore is not available to the bank at all. So they can't give loans with that money. So this money is gone. So if it increases from 3% to 5%, 5 crore is gone. If it increases it to 7%, 7 crore is gone. If it reduces it to 1%, only 1 crore is gone. So by fluctuating the percentage of CRR, the RBI tries to regulate the volume of money that is available in the market for the people to get loans. So this will also in a way protect country economy from going into inflation, are going into the only more demanding or lenders liability. In a way, we don't allow lenders to give loan just because they have money if there is no credit need. So genuine credits will get, the genuine people who want credit for genuine need would get that loan like that. So these are techniques which Reserve Bank could use, and it is also for safety purpose, that if the bank is not performing well, that money is available to repay the depositors like that. So in a way, cash reserve ratio has multiple reasons why banks maintain the money with Reserve Bank of India, and multiple purposes it serves. The other one is statutory liquidity ratio. Statutory liquidity ratio is the percentage of money that banks need to maintain in cash form with them to honor their customers' demands. Suppose if bank has 100 crore deposits and some amount like 5 crore it keeps with the RBI, Then if a customer, and 95 crore it can't give loan. Suppose a customer may come to withdraw his money in his account. So you have to honor the customer's demands. So you have to keep certain amount of money as liquid, that is in cash form, so liquid money. So when you have to maintain your finance in liquid form, that is in cash form, you can't give that percentage of money as credit. So out of 100 crore, if 7% is statutory liquidity ratio, out of 100 crore, that 7 crore you can't give it to the loan. Similarly, if 5 crore is cash reserve ratio and 10 crore is liquidity ratio, out of 100 crore, 15 crore you can't use it for credit purposes. So this is the percentage of money that determine the volume of money that is available in the market. So if one bank has 10,000 crore or 1 lakh crore deposits, even 5%, 7% would mean huge volume of money that is available in the market or not available in the market based on the RBI's percentage determination of cash reserve ratio and statutory liquidity ratio. So these ratios are used first as a safety purpose and also for honoring customers' demand, and at the same time it also affects the volume of money available for the credit purposes that can be lent by banks to the customers. Then the other kind of quantitative measure is called the open market operations of the bank. So open or market operation means selling and buying government bonds in the open market. Government bond is usually in the form of a kind of debt instrument kind of thing, where government promises that a particular amount, suppose you buy 1 lakh infrastructure bond, after 4 years the government promises to repay 2 lakhs. For 1 lakh bond, you will get 2 lakhs after 4 years, or you may get periodic return, something like that. Now, what happens if a bank buys government securities? So, if a banker is buying those bonds, then the money available for credit to the general public will decrease. And if the bank sells these markets, then what will happen when bank sells the bonds available with them? The money will flow into the bank, and that money will be available for lending to the public. So by selling and buying government securities, the banks will get more or less money, whatever it wants. So these government bond transactions, open market transactions, are governed by the Government Securities Act 2006 and also Section 17, 18 and 18A of the Reserve Bank of India Act. So these Act and the Government Securities Act specifies how, where and to what extent banks can transact in government securities. But this is also one of the measures through which Reserve Bank of India regulates the volume of money that is available in the market for credit purposes to the general public, and it is also used as a credit control measure. Now, the other measure is the bank rate. Now, bank rate is the rate at which RBI lends to the commercial banks on instruments such as bills, etc. Now, we have studied bill discounting in the second week. Now, bills are discounted before their maturity period to encourage bona fide commercial transactions, and the rate at which they are discounted determines the extent to which they will be discounted. Now, when the rate of discount is high, it will be less beneficial for the business people to discount their bills, thus leading to avoidance of credit seeking through discount. So they won't go for discounting. If the rate of discount is low, there will be robust discount activity and consequently huge flow of credit. So in a way, simply put, the banks will discount the bills from the customers, and banks can rediscount those bills with RBI. Suppose a bank kept 5 crore for bill discounting. Suppose 3 bills came each worth 3 crore. So it can't honor those bills. So it will discount a bill with its money, and it will rediscount that same bill from the RBI, and it will infuse the money into the market. So, but this is the rate at which the Reserve Bank of India gives to the commercial banks, that will determine the rate at which banks will discount to the general public. So just like that. When the Reserve Bank of India enhances the rate, then people coming for discounting will not come through discounting, they will take the regular loan because it will become very expensive for them. When the discount is very low, then obviously people will come because it is easy money available upfront and before its maturity period, so they will come and discount and the money will go into the market. So this is a kind of credit control measure which helps them to do. So these are on commercial papers. Now the repo rate and the reverse repo. This is the rate of interest charged by RBI on the money lent to commercial banks. So when there is a liquidity crunch and when the banks take loan, this generally Reserve Bank of India is called the bankers bank. So banks can obviously go to Reserve Bank whenever they have any liquidity crunch and they can take loan from the Reserve Bank of India. And whatever rate of interest that is charged by Reserve Bank of India on the money that they have lent to commercial banks is called the repo rate. When the repo rate itself is high, suppose if the RBI is giving at 5.5 repo rate, then commercial banks will give to us to 6 or 7, something like that. Generally, they can't give less than 5.5. Suppose if the repo rate is 6, then we will get loans at 7 or 8, like that. So this will determine the rate at which general public will get loans or rate of interest on their credit. And the reverse repo rate is the rate of interest given by the RBI for the funds deposited with it by the commercial banks. So we have seen cash reserve ratio and other funds which the reserve fund which the banks will keep with the Reserve Bank of India. On those funds, the rate of interest that the Reserve Bank of India gives to them, that is called the reverse repo rate. And with these rates also, suppose if the RBI is giving huge interest on the reverse repo rate is very high, then banks, instead of giving it to commercial lending, they will put huge money with RBI. So this will also determine the quantity of money or the volume of money that is available for the public to get credit. And in a way, the people, when the rate of interest is very high, also people will not come to take loans so much because they are already scared that there is rate of interest is very high. Maybe the loan repayment obligation will become burdensome for them, like that. So one major thing is banks definitely have emerged as the most sought after institutional lender to the borrowers in India. So, and if the credit needs are not matched with credit accessibility, economic growth of the nation will suffer. So we need to regulate and channelize credit flow, which is a requisite economic function of national importance. And as part of credit control measures, we discussed both qualitative credit control measures and quantitative credit control measures. Both these credit control measures, qualitative and quantitative credit control measures, collectively, what we call it as selective credit control, this, all the credit control measures put together, qualitative and quantitative measures put together, keeps our economy in a very healthy state and make sure that the credit needs of the nation and the credit needs of the public and the value of currency in the market, all these are maintained, so that the RBI ensures that there is no inflation, that the credit needs of particular weaker section people are also addressed, and the credit needs of the marginalized farmers or any other sector which require the credit support are addressed. All these are ensured by the credit control measures that the Reserve Bank of India takes and gives as directives to the banks in terms of through its master directives or by its directives, and the banks are bound to follow them by virtue of the provisions that are contained in the Banking Regulation Act and the Reserve Bank of India Act. So both these statutes empower the RBI to regulate the banks, and the power is very far and wide. It can give to general instruction, it can give to special interest instruction to one particular bank or to all the banks, or like that. So it's a very far reaching power that the Reserve Bank of India has, and credit control is a major tool through which government's economic growth is properly channelized, or in a way we integrate our planned economic development with that of the financial access that is required for that growth. In a way, this is one of the major measures through which we help the nation to grow in the direction we are anticipating and visualizing. So this helps the government to plan properly and execute it also properly. So RBI being a banker to the government will help achieve that objective in a very systematic way by giving proper directions at appropriate time. So with this, we conclude our discussion on credit control, and we will discuss about banker customer relationship in the next class. Thank you.